The stock market. At first glance, it may seem like nothing more than a place where people buy and sell stocks. However, in reality, the stock market is a massive financial marketplace where some of the world's greatest fortunes are built, the pulse of economies is measured, and millions of investors make decisions every single day. So why do some people consistently earn profits from the stock market for years while the majority lose money? The answer is not luck. It is knowledge, patience, and the right strategy. First of all, you should know this. When you buy a stock, you are not simply purchasing a piece of paper. You are becoming, however small, a shareholder in that company. If the company grows, generates more profit, and strengthens its future prospects, its stock price may also tend to rise over time. That is why successful investors pay attention not only to price charts, but also to the company's financial condition, growth potential, industry, and management. One of the biggest mistakes new investors make is assuming that a stock is cheap simply because its price has fallen. However, a low price does not always mean a good opportunity. Sometimes a stock is genuinely undervalued, while other times it has declined because the company is facing serious problems. Being able to distinguish between these two situations is one of the most important steps toward becoming a successful investor. In the stock market, you will often hear two terms, a bull market and a bear market. A bull market refers to a period when prices are generally rising and investors are optimistic. A bear market, on the other hand, is the opposite. Prices decline, fear increases, and investors begin selling. Interestingly, a significant portion of history's greatest fortunes was built by patient investors who remained calm while others were selling out of fear. One of the defining characteristics of successful investors is their ability to control their emotions. In the stock market, your biggest enemy is often not the market itself, but your own psychology. When prices rise, greed takes over. When they fall, fear sets in. If these emotions are not controlled, people often end up buying at high prices and selling at low prices, resulting in losses. Another important concept is diversification. Experienced investors rarely invest all of their money in a single stock. Instead, they spread their investments across companies in different industries to reduce risk. Even the strongest companies can be affected by unexpected events. Diversification is one of the most effective ways to minimize potential losses. It is also important to understand why long-term investing matters so much. In the short term, stock prices can be influenced by news, rumors, and market sentiment. Over the long term, however, a company's actual performance tends to be reflected more accurately in its stock price. That is why many successful investors choose to invest in high-quality companies and patiently hold them for years. In addition, before making an investment, it is essential to examine key financial indicators such as the balance sheet, income statement, debt levels, profitability, and cash flow. Companies with strong financial foundations are generally more resilient during periods of economic uncertainty. One of the most important truths to remember is this: the stock market is not a shortcut to becoming rich. For those who make informed decisions, manage risk effectively, and think long-term, it can be a powerful tool for building wealth. However, for those who act without a plan, the very same market can lead to significant financial losses. In conclusion, success in the stock market is not determined by choosing a single winning stock. It is determined by making informed decisions, remaining patient, learning how to manage risk, and replacing emotion with strategy. Because the investors who succeed are not those who can predict the future with certainty, but those who are able to make sound decisions in the face of uncertainty.